Here's the thing. In a couple of days, it's going to be September. And you need to know that September is historically the worst month for US stocks. I'm going to explain exactly why and what you need to do to take advantage, because yesterday the stock market did begin a bit of a slide, and so, this may already be starting. As always, I'm going to give you some news and some highlights as to what's been happening over the past week and what's going to affect the stock market, or what already has started to affect the stock market. And also, I need to take a quick second and apologize, because last week I totally forgot that I didn't do what I told you I was going to do. Each Saturday, my goal is to answer a question from last Saturday's video. So, if you have a question that you want me to possibly answer, go ahead and throw that in the comment section right now. But last week, I didn't do it and this subscriber lovingly helped remind me. So, again, I apologize and I'm not going to let it happen for this video. So, let's start with that question from 2 Saturdays ago, so that I don't forget it. Let's get it out of the way right now. And this was a good question. It goes really well with the topic of today's video. This guy asked, should I sell all my holdings due to the possible dip? And for this answer, it's very easy for me to just say no and move on. But, let me answer it fully. For the most part, no. I don't think that this is smart. But it does depend on what you're invested in. If you're in my 3-fund portfolio or something tried and true like the S&P 500 or the total US stock market, then no, it's actually been statistically a very terrible idea to try to time the market. And basically, by selling out and waiting for the dip, that's timing the market. Now, if you are somebody that's worried about a big dip, it's likely that you have one of two things that's going on. First of all, you might be just invested in too risky of assets. And so if you're speculating, you don't know what might happen and that it might drop further than you'd like it to. That could be an indication. The other thing might be that you actually have money invested that you might need in the near future. So you're just overly worried about that. If either of those are the case, then yeah, it might be a good idea to reassess, and it might actually be smart to sell out of those so that you can start back fresh. Generally though, as long as you're being a long-term investor and long-term minded 5 years, 10 years, 20 years down the road, as long as you have an emergency fund funded up and you don't need the money anytime soon, then generally it's going to be okay for you to keep your money in and get through these small dips or even large dips. And even if there are large dips, just keep DCAING or dollar cost averaging through it. And statistically, that has been the strongest way to invest. Selling because you think there's going to be a dip seems like a good idea, because I'll just sell out right now and then buy in when it goes down. Well, yes, if that works out perfectly, then yes, that would happen. But also, you have to keep in mind you're going to have a taxable event if you're selling in a taxable brokerage account. You may and probably will miss the actual bottom to buy back in, because you're going to think it's going to keep going down further and really it's going to just start coming back up, and then you're going to panic buy and you're going to just be overly stressed out trying to figure out this whole thing. All I know is that I work with many retirees, and the number one reason why they think that they don't have as much money as they probably could have had is because they kept a substantial amount of money outside of the market for a substantial period of time, because they were waiting for that dip. That eventual dip was supposed to come and they lost 5 years, 10 years worth of compounding because they're waiting for this huge dip. So, this is a good question, and honestly one that probably most of us have just in general. But, honestly, for the most part, it's going to be better just to weather the storm, and if something does dip, just buy in heavily. So, now in other news, what I keep seeing and something that just came up this week revolves around the crypto market. And Tom Lee just said a crazy price prediction specifically for Ethereum by the end of 2025. Then after this, I'll go over the September market dip that we may be in for. So Tom Lee predicts Ethereum rally to $5,500 soon, $12,000 by year end. I don't see it being that bullish, but I am very fascinated with and invest in Bitcoin and Ethereum. So I definitely suggest that you take some time and learn about these assets and definitely educate yourself. This is why I'm super excited to introduce the sponsor of today's video, which is 21 Shares. 21 Shares is one of the world's leading crypto exchange-traded product providers, making it easier and more accessible for everyday investors to gain exposure to digital assets. You know, I've been invested in the crypto world for more than 8 years, and so I really like what 21 Shares is doing. Their mission is to bridge the gap between traditional finance and crypto by offering secure, fully collateralized and regulated investment products traded on global exchanges. 21 Shares offers spot ETFs on major assets like Bitcoin and Ethereum. I love how on the 21 Shares website,